Good afternoon, everyone. Welcome to the webinar on consequences of intangibles under CIRP liquidation cases. Today, we have with us a chairman of Insolvency and Valuation Standard Board, C. Gyanchand Mishra sir. And today we have with us a speaker of the session, Vikas Goyal sir. Let me, before introducing Vikas sir, let me ask Gyan sir to give a opening remarks. Sir, you are on mute.
So thank you very much, Nancy. Very good afternoon to one and all. Very respected speaker of today's webinar, CA Vikas Goyal ji, a very distinguished professional, and of course, having experience of more than 17 years in the professional arena, like auditing, assurance, finance, training. He worked with best of the Indian accounting bodies like PwC, EY, Jax Research, both in India and of course in Canada. So I'll request Nancy to give a detailed introduction of Vikasji after I complete my introductory. So friends, today we have a very important webinar on very important topic, consequences of intangibles under CIRP, especially liquidation cases. And we understand that nowadays so many cases which are under CIRP and which could not be resolved, those are going for liquidation. Liquidation is very important process to be carried out by any insolvency professional or liquidator. And of course, this tedious task as well. To understand the intricacies, today's webinar will certainly have a fruitful direction for the liquidators with respect to the intangible under CIRP process. So friends, we know that IBC 2.0 is on the way, and in this winter session, the new bill is expected to be passed by Honorable Parliament. The Institute, along with IIPI, has given its representation to the government, to the select committee, with respect to the various changes which we are expecting and which ought to be in the best interest of the ecosystem of the insolvency. We are expecting that this new insolvency law, which is coming very soon, will certainly pave the path of the professionals in their practice, as well as we are expecting that the ecosystem will improve. The delay and late at the court level, which is of course, somehow a very negative concern as of now, matter of negative concern. So that we are expecting to be resolved. Some very important changes which are going to take place in this new law is with respect to the CIRP process, with respect to the timeline, newer horizon, with respect to the COC monitoring, those we can expect in coming time. So I'll not speak much, just one more information I would like to share with you. Like we did in last 2 years, Resolve 2023 in Singapore and 2024 in Bharat Mandapam, New Delhi. This year, Resolve 2025 is going to be held in Mumbai in Hotel Aurika on 1st and 2nd December 2025. We'll request the members to kindly join the event, not only to learn, but also for the purpose of networking and to understand the importance of the insolvency and liquidation. So many, speakers across the country, judges, attorneys, insolvency professionals, valuation professionals, and of course the regulators, IBBI and NCLT members are also joining this program. We are expecting more than 500 persons to be there, and most importantly, this is going to one of the biggest insolvency program being held in the country so far. Truly an international event. We are expecting members from the foreign and global stage also. So we'll request all the participants who are joining who are not yet registered, kindly do register for Resolve 2025 and try to understand where we are moving in the coming time. As we know that the global gateways are opening for the Indian insolvency arena. The group insolvency and cross-border insolvency is on card in IBC 2.2 being launched by the government very soon. So please register yourself, join the event, and understand, network, and most importantly, take the note of the future of the profession, which is going to lead the country. So thank you, Nancy, for organizing such a wonderful event. Today I can't see Sarika Madam; she's on leave. So I am thankful to the each and every member of the board. Thank you, and Vikasji, over to you. Over to you, Nancy, please.
Yes, sir. Thank you so much, sir, for your opening remarks, sir. And now, let me introduce Vikas Goyal, sir, who will be taking this session on consequences of intangibles under CIRP liquidation cases. Let me introduce Sir. Sir is a professional valuer, an entrepreneur with around 17 years of professional experience spanning auditing, finance, training, and valuation. He has worked with companies like PwC, EY, ICA, and Zacks Research in India and Canada. He has been exposed to global valuation and business modeling practices for companies. Sir is a chartered accountant, CFA, MS Finance, MBA, IIM Calcutta, registered valuer. Sir is an author of multiple books on valuation published by leading publishers, over 3,000 copies sold so far. He is an active trainer and speaker with hundreds of hours of training experience. He was awarded CA Business Leader 40 Under 40 by ICAI and CNBC TV 18 and has been a special invitee and cooperative member on Valuation Standard Board of ICI 2023 and 2024. So thank you, sir. Welcome, and over to you.
Very much, ma'am. I do realize that the introduction has to be shortened, considering the kind of audience we have here. It's too large an introduction. Thank you so much. Am I audible to everybody?
Yes, sir. Yes, sir.
Yes. Thank you. And thank you, Gyan sir, for inviting me once again. I'm quickly sharing my screen. Please confirm when you're able to see it.
Yes, sir. It's visible.
Visible. Thank you so much. So, between the time I was asked to do this program and today, I'm very thrilled to inform that there is a major change that has happened on behalf of by IBBI, and they've come up with a very interesting document that is asking for public comments, and something that I have been shouting and arguing for the last 6 years at least, probably a little more than that. And finally, it has got IBBI's attention. So we're going to talk about that a little bit, right? So this is what it is. Now, IBBI has just come up with a document which says that they are going to revise the fair value. How many of you have actually seen that new document that IBBI has come up with? It is asking, it is open for public comments, and there are a lot of changes that they are proposing in the CIRP regulations, especially on the valuation side. Can we have a quick sort of poll or thumbs up, or we can use a chat window? I'd like to keep this discussion very interactive, please. Yeah, how many of you are familiar with that document? It's recently come up this month itself.
So sorry to interrupt. One thing. So shall we take questions at the end? Is it
Ma'am,
okay,
I like
sir?
to keep it interactive,
20 minutes?
So, yeah. No, ma'am, we'll
Okay,
keep
sir.
it interactive. I think that'll ensure that nobody is keeping their questions in the mind. We'll try and cover everything in 2 hours. We have 2 hours, right?
Oh, yes, sir.
Yes, let's keep it interactive, ma'am. Otherwise, I'll get bored myself, please.
Okay, sir. Okay, sir.
Thank you so much. Okay, so yeah, I'll love to get your responses either as thumbs ups or as chats, and we can even have conversations during the discussion, please. Right? So so basically, IBBI has just come up with a document. It says that they want to standardize the whole valuation regime under CIRP again, and there's concept of a coordinator valuer. There is concept of only one registered valuer for small engagements. And very interestingly, there's a concept of redefining the concept of fair value, right? Now, one of the biggest things that we've seen in case of CIRP engagements is that whenever a company was going in for CIRP, the insolvency professionals were required to sort of appoint the valuers. Now, 2016, 2017, 2018, in the early days of CIRP, what used to happen was that the IPs would appoint one valuer, and then that valuer would go on to reappoint the land and building and the plant and machinery valuers, because securities and financial assets would mean the business itself. Now, that used to be the practice. There was some objections from the LNB and plant and machinery valuers, saying that why is a valuer appointing another valuer? So IBBI came up with a clarification, and they kind of ensured that it is the IP who is appointing three different classes of valuers. So you have a securities and financial asset valuer, you have a land and building valuer, and a plant and machinery valuer. Now, if a valuer is a registered valuer entity, things were easier, because ultimately it's still one entity which is being assigned as the valuation engagement. But whenever the three different classes of valuers were assigned, the biggest miss that was happening was that you were only valuing businesses, you were only valuing the assets based on what is there in the balance sheet. So until and unless the COC or the resolution professional clearly saw the presence of an intangible, which is in most cases a brand or any sort of intangible was not getting recorded, right? So a securities and financial asset valuer would invariably only look at what's there on the balance sheet. So they would value, let's say, a trade receivable or inventories. Again, there's a lot of discussion around inventory being a financial asset or not a financial asset. It got clarified that it's a financial asset, right? So everything that's there on the balance sheet was getting assessed, but anything that was not on the balance sheet was not getting assessed, right? Unless it was a registered valuer entity. So only in very selective cases, it was getting assessed. Now, what we saw was that after the valuation was done, after the resolution was done, the resolution applicant would often merge the CD, the corporate debtor, into their own company. Now, if it's a large organization, I hope you understand the concept of purchase price allocation, right? So if company A has acquired company B, which is a corporate debtor, as part of a resolution plan, they would essentially, the resolution plan would say, we will merge this company into our own. Once the merger is there, then you have Ind AS 103 business combinations leading to a purchase price allocation. And now the company has got the resolution applicant, which is company A, has got the corporate debtors pennies to $1. And now they would start recognizing intangibles, right? So this intangible, which was there when the company was doing okay, it was there. When the company was not doing okay, the intangible value went down. And now the resolution applicant has bought this company and through a resolution plan. And again, he's recognizing the intangible. So only the COC or the lenders were not getting any benefit of these intangibles, right? So that's been the background or the story behind the whole intangibles as part of CIRP. We've been talking about it that, hey, we need some more standardization around how to deal with intangibles of corporate debtors. So now IPBI is saying that it needs to explicitly include intangible assets such as brand, intellectual property, customer relationships, know-how, and goodwill, which are increasingly central to the enterprise value. And therefore, they are proposing to redefine the fair value, where this is the existing definition, but they want to add an explanation where they're saying that the estimated realizable value of the corporate debtor would be computed by taking into account the total estimated realizable value of all the assets, including but not limited to tangible and intangible assets, along with their underlying synergies. Now, this is a draft note. It is open for public comments. We have to give our comments on this. I am talking to a fraternity which is very, very learned. It affects them directly. So what we need to, at least the things that I see here is that we need to ensure that these things must be still updated, right? So the concept of goodwill, it should still flow from Ind AS, because otherwise if you put the concept of goodwill here, It's going to create a lot of confusion amongst the market participants. And then again, along with underlying synergies, whenever we use the word underlying synergies, we are talking about synergies in case of a merger or an acquisition, right? So if you value the company, if you estimate the realizable value based on the underlying synergies, that means you are keeping a particular resolution applicant in mind, which will again going to create some issues. So this still needs to be addressed. We need to give our solutions or suggestions that these have to be reworded. But a very, very good thing is that CIRP engagements now will require the valuers to assess the intangibles, right? Let me take a quick pause here, understand if we have any questions, if we have any views. Ma'am, I'm not able to see the participants list. I'm not sure if I can see the participants or not.
Sir, no, sir. It's the back end that you are unable to see, but there
Okay.
are no such questions right now, sir.
Okay, all right. So you will let me know if there's a question, okay? Is that right?
Yes, yes, sir, I'll let you know.
All right. Thank you so much, ma'am. Really appreciate your help here. So what is an intangible asset, right? So again, the concept of intangible borrows its definition from Ind AS. It's very well established now, right? So intangible is basically a non-monetary asset that manifests itself by economic properties. It has no physical substance, but grants rights or economic benefits to its owners. Ind AS 38 or IAS 38, that is IFRS 38, talks about intangible assets are identifiable non-monetary assets without any physical substance. Now, Ind AS 38 and IAS 38 goes on to clearly lay down very detailed principles of when you should recognize an intangible, how you should measure an intangible, and so on, right? And this has been, in our practice, we come across a lot of business owners, professionals who have a lot of doubts around intangibles. So I think this session will help us sort of address some of them. So intangible requires identifiability. Now, when we say identifiability, we are talking about separability and contractual or legal rights. So separability means the intangible should be capable of being separated or divided from the entity. It should be able, you should be able to sell it, license it, transfer it, rent it, exchange it, whether or not you want to do it, right? Whether or not the entity intends to do it, but it should be separable, right? And second is intangible should arise from contractual or legal rights, regardless of whether those rights are transferable or not. So A, you have to be either separable. B, it should give you contractual or legal rights even if it is not separable, right? And then you have to have control. So if the entity has the power to obtain the future economic benefits or restrict the access of others to those benefits, then you get control, right? Again, a quick question to anybody. How can you give me an example of an intangible where you can restrict others access to some benefits? Can you give me examples of some intangibles where an entity can restrict the access of some benefits to the others, right? What could be that intangible? Again, I'm going to hope that some of you are responding to this, right? I think I still can't see chats because there's a
Sir,
front
just to
end and a
tell
back
you,
end because it's a
sir,
webinar.
200 have already joined, sir.
Amazing. That's lovely, right? And are you able to see some responses,
Sir,
ma'am?
not yet. The questions are not yet there.
Okay. Okay. All right. So
But
examples of such
responses are
controls.
there, sir.
Okay. So can you give me some of those responses? I'm sorry, I'm putting
It's
you.
just normal hi, hello, good afternoon kind of.
Okay. All right.
Okay.
So examples of such controls could be, let's say, a patent. So I know access to some formula. Only I can derive those benefits. I will restrict those benefits to somebody else, right? The second example is a non-compete agreement. So if you have a non-compete with the other party, right? So this party, the other party who has signed a non-compete with you, will not operate in this business or in this geography, depending on what's the content of that non-compete. So even if you don't get benefit of this, the other person will not get benefit of this, right? So you're restricting the access of some benefits to the other person, right? So that's an example of control. So an intangible needs to have separability. It should have contractual or legal rights, and it should be able to control the intangible. Okay. And again, you observe that separability and contractual are not they're not complementary. So it's okay that you have contractual legal rights, but it's not separable. Okay, and we'll see some more examples around it. So an intangible can be recognized only and only if it is probable that the future economic benefits that are attributable to the asset will flow to the entity, and the cost of that asset can be measured reliably. Now again, let me give you the context of why we are discussing this. We are supposed to talk about CIRP engagements and intangibles under CIRP engagements and strategic implications around it. We are also supposed to talk about valuation of those intangibles. But why are we getting into Ind AS 38? So if I am a valuer, or if I'm a resolution professional, or if I'm a resolution applicant, right? What's the point of recognizing or valuing an intangible if the resolution applicant cannot recognize it? Okay. So until and unless the resolution applicant can recognize it, there is no point of identifying any intangible. And that's the reason why we are going back to recognition of intangibles under Ind AS 38, because these principles should guide us whether an intangible should be identified or recorded or valued at all. If it doesn't meet these criteria, even if you recognize an intangible, even if you identify and value an intangible, you will not be able to recognize in the financial statements. So again, Ind AS 38 talks about you need to assess the probability of the future economic benefits using reasonable and supportable assumptions. So again, this is for valuers, right? Assess the probability of the future economic benefits using reasonable and supportable assumptions that represent management's best estimate of the set of economic conditions that will exist over the useful life of the asset. Now, again, these words are very, very well drafted. Just imagine this, right? What happens in most cases, a professional will say that this is what I estimate today. Okay, as of today, this is what I foresee. So now the valuation principles under Ind AS 38 says that you need to estimate the economic condition that will exist over the useful life of the asset. A classic example again here is, let's say, a technology. So if technology is an intangible that you are identifying and valuing, you can't say, I think this technology is very valuable today. You need to estimate that this technology is likely, again, best estimate, likely going to be beneficial over, let's say, the next 5 years or 7 years, right? So during the next 5-7 years, the technology will still carry some value, is something that you will have to have reasonable and supportable assumptions around. Okay, yes, you will estimate this today. So on the basis of evidence available at the time of initial recognition, again, it says that you have to give greater weight to external evidence. So when you are getting the evidence, so management says that we have done our internal estimates and we think that this is going to remain. So again, you will have to find some industry reports. You will have to find some thought leaderships, some external evidences which will say that this technology is going to be relevant over the next 5 years or 7 years, right? And then, of course, you can elect to record the intangible at cost or revaluation. So again, my whole purpose of saying this was to help you give a perspective that under CIRP engagements also, when you are valuing intangibles, when you're recognizing intangibles, Ind AS 38 or IAS 38 is going to be of tremendous importance from a guidance perspective. Okay, moving on. So Ind AS 38 also talks about the cost of the intangibles. So again, remember we said that if an intangible may be recorded, or it may be acquired, or it may be internally generated. So we'll come to that in a moment. But if you're looking at the cost of the intangibles, what are the costs that can be included? So you will include the purchase price, you will include the import duties, you will include non-refundable purchase taxes, directly attributable costs like employee benefit arising directly from bringing the asset to the working condition, professional fees, cost of testing, etc. But then it also says that these are costs that you cannot include. So advertisement and promotional expenditure, you can't include. And this is a very, very common area of discussion amongst the clients, that we have spent so much money on advertisement, promotional, and a classic example here would be brands, right? So you cannot capitalize the advertisement and promotional expenditure. You cannot capitalize the cost of introducing a new product or service. You cannot capitalize the cost of opening a new location or obtaining new customers. And we'll talk about customer list. So customer list is an intangible, but then how do you recognize that is very important. Staff training, general administration costs, you cannot recognize these. Also, right, very important is it is clear about the finance charges. So if a company has taken a loan and the company is amortizing or it is capitalizing the interest expenses, the finance charges, Ind AS 38 clearly says that you cannot capitalize finance charges beyond the cash price equivalent value of that intangible. So if you had not taken a loan, what would have been the cash price equivalent of that intangible? You can only capitalize the finance charges up to that point. Beyond that, you cannot capitalize. Okay. And then cost incurred while the asset is ready but not yet brought to use. Okay. So costs that are incurred after the asset is ready to use cannot be capitalized. So these are very, very clear guidances on what you should capitalize, what you should include as cost of the intangible. Ma'am, you
I
can
have
keep
two
interrupting, ma'am.
questions.
Yes, please, ma'am.
No, sir. Sir, there's one question. Can the judgmental skill of doing business of key personal individuals of the company be called out as intangibles?
So, ma'am, again, they would have to follow these criteria, right? Are you separable? And are those skills coming from the contractual or legal rights, right? So usually these will not be identified as intangibles. And a more structured response to that is any skill of any individual is usually not forming part of an intangible. For example, we'll come to this in a presentation today. One of the classic examples is assembled workforce. So think of all the software companies, all the pharmaceutical companies, etc. Right? They have amazing skilled force. So now these and think of professional services firms like Big Four, for example, right? So all these firms get their value from the amazing talent of the people that they have. So we call them as assembled workforce, and assembled workforce is subsumed as part of goodwill. It is not recognized as a separate intangible. So the answer is no, you would not be able to recognize that.
And sir, the next question is, so whether there are intangibles on books or not, the valuation has to be carried out necessarily. It's like confirmation from you needed.
No, so we will have to assess whether there is an intangible. So how would you value an intangible if it is not there, right? So the idea is what the new document is saying, in my view, is that earlier we were not considering those intangibles while valuing the corporate debtor if it was not on the balance sheet. Now the resolution professional will ask the valuers to see if there is a suitable intangible. If yes, then you will value it. Otherwise, you will not value it.
Yes, sir, please proceed.
Yeah, thank you so much, ma'am. And you can please let me know if I have answered the question suitably on behalf of the participants, because I can't hear
Yes. No, sir, you are.
Thank you. So again, a very common question that comes up is that can you capitalize research and development expenditure, right, on intangible? So again, Ind AS 38 is very clear that research expenses needs to be expensed immediately because you cannot prove the future economic benefits. So it says that you have to divide the research and development into two phases, the research phase and the development phase. Research phase expenses have to be expensed, that is charged to the P&L. So you will never be able to capitalize that. Development phase, it can be capitalized if only all the 6 criteria are met. What are these 6 criteria? Technical feasibility of completing the intangible, that you think that you will be able to complete the intangible, intention to complete and use or sell it, ability to use or sell it, probable economic benefits demonstrated through market existence or internal usefulness, availability of resources, that you have the technical, financial and other resources available to complete it, and ability to measure the expenditure reliably during the development, right? So of course you can imagine that these are very broad points. Some of it can be fairly subjective, right? But Ind AS 38 lays down very clear guidances on how to charge the development expenses. Only if all the 6 criteria are met, then you can capitalize the development expenses and create an intangible which is generated internally. Again, classic example is software companies, pharmaceutical companies, which do create internally generated intangibles, and it's a fairly complex set of accounting processes that have to be followed, right? in what happens in case of acquisition. So again, we are talking about CIRP engagements from a resolution applicant's perspective, right? The R&D in process R&D. So if a company is acquiring a corporate debtor which has an in process research and development expenditure, then the in process R&D will be recognized as intangible at fair value. Post acquisition, you will expense the research costs and you will still apply the development costs as per rules mentioned above. So basically, if I am a resolution applicant and I am acquiring a corporate debtor, and this corporate debtor has some R&D which is in progress, that is not a ready intangible yet. So I will do the fair valuation of this in process research and development expenditure, and any further R&D expenses I will capitalize based on the rules that we have just discussed in this slide itself. So again, it's a very important guidance for valuers. It's a very important guidance for resolution applicants. They must assess this before they decide on buying or bidding for a corporate debtor, right? Because these rules will have to be followed. So again, these are important strategy considerations for resolution applicants. Now, normally, again, globally speaking, we have 5 different types of intangibles. There are marketing related, customer related, artistic related, technology related, and contract related, right? So we'll quickly talk about some of those examples, right? And then we'll spend more time on the valuation aspects first. So marketing related intangibles examples would be trademarks, trade names, including brand names, service marks, collective marks, certification marks, trade dress, newspaper mastheads, internet domain names. So again, very, very commonly used are internet domain names, trademarks, and non-compete agreement. At least we are seeing this as very, very common intangible assets. Customer related intangible assets, customer lists. Again, it's very important, very, very common, right? And then you have production backlog, order backlog. So again, this would be applicable in case of heavy industries like construction industries, real estate industries, where a company is getting acquired and then it has orders in place, and there's a production backlog or an order backlog. Then you have customer contracts and related customer relationships, very common. Non-contractual customer relationships do not. So again, you see these marks, right? So just for your understanding, what are these marks referring to? Okay, so whenever you see an equal to sign, we are saying that these are those intangibles that would be recognized apart from goodwill because they meet the separability and the contractual legal criteria. So you can recognize these intangibles. But the other ones, like the one you see here, the customer list or non-contractual customer relations. So internally generated intangibles, which are customer list or non-contractual customer relationships, do not get recognized. So they do not arise from contractual or legal rights, but they do meet the separability criteria, and separability criteria is not a necessary condition. So again, please note that customer list, if it is internally generated, cannot be recognized as an intangible asset. Customer list, if it is acquired as part of a resolution plan or an acquisition, can be recognized as an intangible asset. But again, you will have to see whether there are legal rights that are available, right? So just having databases bought from the market might not help you build an intangible asset, right? There's a lot of questions that we get around customer lists. Then you have artistic. Yes, ma'am.
So there are 2 questions.
Please go ahead.
First is, please clarify the finance charges recognition by way of an example.
Interest expense. We are simply talking about if a company has taken a loan, right? Sometimes you capitalize the interest expense. So any interest expense which is incurred only up to bringing the asset at equivalent to a price. I mean, if it was without a loan, right? Only till that extent you can capitalize the interest expense. Anything beyond that, you cannot capitalize it. That's the simple guidance that is there. If it is a complex debt arrangement, then we haven't come across that, so I will not be able to clarify further.
Then another one is how the intangible not existing on books shall be found out.
We'll talk about that, ma'am. The entire session is about that. Yes.
Okay, sir. Please proceed.
Thank you. So artistic related intangible assets, you can have plays, operas, ballets, books and magazines, musical works, pictures, audiovisual material, videos, music videos, and all of these. And then there can be technology based intangibles, which could be patented technology, computer software, unpatented technology, databases, trade secrets, etc. So the person who had just asked this question, where I said, where I was asked that how can you value an intangible which is not there in the books? So let's take classic examples, right? I have a trademark. Now, let's say I run this company called Omnifin, and Omnifin is a trademarked business. Now, if you look at my own balance sheet, Omnifin will not appear on the balance sheet because it is an internally generated intangible, and the cost of a trademark is going to be barely 20, 30, 40,000, not more than that, right? But tomorrow, God willing, if Omnifin becomes a very, very large organization, where just by using Omnifin's name, you will start getting business in whatever fields we operate in, right? So can I not do an arrangement where I will ask people to, okay, give me a royalty and allow them to use my name, and of course I'll maintain quality. So what happens then? Omnifin is my brand, right? And I am monetizing this brand by giving it, like, let's say, on a royalty basis or a franchise basis. Now this is where I am monetizing the asset and somebody is paying me royalty. Still, no asset is recognized, right? But God forbid, tomorrow, if I don't exist, but the company is still doing well, somebody wants to buy Omnifin. So, would you buy this company at book value? I won't sell it at book value. So, anything that you pay premium over and above the book value, which is what we call as the fair value of the company. So, what's the difference between fair value and the book value? Why would you pay me anything above the book value, right? So, of course, the normal answer, and we all understand this as valuation professionals, is that it is a future economic benefits. So, this differential between fair value and book value, can I attribute a part of it to the brand or to the trademark? If yes, so the acquirer, right, in the absence of any such intangible, so let's say my book value is 100, and you have acquired this company, let's say, at 500. So what would happen? Normally, 400 would be goodwill. Yes or no? Right? But now I'm saying that this 400 is not goodwill. Out of this 400, 200 is about the brand. And the balance 200, because there's no other intangible, this is goodwill. So how do you identify this 200 as brand value? It's not there in my balance sheet, right? It will only be available in the acquirer's balance sheet. And we'll talk about how do we value brands or any such intangible for that matter. But that's the context of valuing an intangible which is not there in the CD's books. Okay, think of some of the very interesting brands that have interesting companies which had a very known brand, but then they didn't survive, they didn't do well, right? I don't want to take names of any companies, but then you can think of good brands which have gone into CIRP. So for some of them, the brand valuation was leveraged. Some of them, the brand value was not leveraged. So now we are having a situation where IBBI is saying that consider if there is an intangible that can be valued. I'm moving ahead, and if you have follow-up questions, I'll be happy to take it. And then you have contract or license, contract-based intangibles. These could be licensing agreements, royalty agreements, right? Advertisement, construction contracts, lease agreements, construction permits, franchise agreements, and so on and so forth, right? You can have employment contracts, etc. So these are all examples of contract-based intangible assets. Some of these could be available in the CD's balance sheet. Some of them may not be available in the CD's balance sheet, depending on India's 38 criteria. So now we will have to consider which of these could be there. Okay. So again, like I said, internally generated brands, mastheads, publishing titles, customer lists, and items similar in substance shall not be recognized as intangible assets. So again, this is clearly laid out as per India's 38. So, but then if it is internally generated, if it can be acquired, we can always value them and recognize them. Now, I want to skip goodwill for the time. Does everyone understand how do we recognize goodwill? Can we have a quick, is there any question or can someone share a view? How do we recognize goodwill? So there's a way of recognizing goodwill that we studied in high school, in our BCom exams and so on, right? And then there's a way of recognizing goodwill under Ind AS. Okay. So is there a difference? So normally under India's 38, the value of goodwill is typically measured as the residual amount after the values of all the identifiable tangible and intangible and monetary assets have been deducted from the value of a business. Okay. So basically what will happen, I will have a purchase consideration less, I think I have it in the slide. Okay. Yeah, I'll go back to the previous example once again, but this is how we recognize goodwill today. So in an acquisition, whatever purchase consideration you've paid, less fair value of all the assets minus the liabilities. That is, the fair value would be different from the book value. Please remember that, of course, right? So once you've deducted that, all the balance sheet assets and liabilities, net of that, this will give you the value of all the intangibles. I already explained this in the previous example. Less fair value of the other intangibles which are not identified in the books. Example, customer list, brand, customer contracts, trademark, etc. What you get is the goodwill. And of course, we look at it on a prorated basis if the acquisition is not 100%, right? So this is how we recognize goodwill, as opposed to what we used to do earlier. We would look at, let's say, a number of years purchase method, right? So we would say this was one of the ways of recognizing goodwill. We do not follow this anymore. Yes, ma'am.
So there's one question related to intangibles. Is there any cap to intangibles getting recognized in balance sheet? Because intangibles mostly driven by fair value valuation and controlled by the valuer professionals.
Is there a cap? Is that's the question, right?
Yes, sir.
No, there's no cap, ma'am. See, again, I wouldn't really agree to the statement that the fair values are controlled by the valuation professionals. Valuation professionals are reasonably accountable for saying whatever they are saying, right? So, in fact, this whole regulation is also bringing in more accountability on the part of the valuers that, hey, you need to see if there's an intangible, and if there is an intangible, you need to value it and record it. Yes, one could say that valuers know how to do it, but then they're not the ones who are controlling it, right? I mean, the value would come only if it can be defended, only if it is existing. Otherwise, that value will not be there. So there's no cap as such. No.
Okay, sir. Please proceed. Thank you,
Thank
sir.
you. So that's about goodwill. Let me talk a little bit about brand. I think this is one of the core topics for our session today. How do you recognize brand? How do you value brand? Right? So brand basically is a marketing related intangible. It may include logos and names and terms that are helping a company to identify or their products and services, and it helps create a distinctive image and associations in the mind of the consumer, right? So there's a lot of work that happens around brand identification, brand valuations, and so on. It creates economic benefits for the owner of the brand. For all the participants, I think the easiest way to understand a brand value is try to recall the advertisements that we've seen on TV for so many years, right? Try to recall a Surf Excel advertisement or a Colgate advertisement or a Tide detergent advertisement or I mean any FMCG product advertisement, right? What did the advertisement say? It says that Surf Excel is better than an ordinary detergent, right? Colgate is better than an ordinary toothpaste. Tide is better than an ordinary detergent, right? Savlon is better than an ordinary antiseptic, whatever, right? So every time you think of a product which had a brand, it would say that they are able to generate a premium over the ordinary product, right? Even in our own profession, sometimes we say that, hey, this company is able to get a good engagement because it's a brand. So again, we are justifying it right there, right? That a brand will allow a company or a product to generate higher revenue, which means it would be able to generate either command a higher price or a higher volume or both, right? And more. So when we do brand valuation, sometimes there's a lot of myth around brands, and we'll talk about this, right? So brands could be a company brand. Think of company brands. A company brand could be an ITC or a Tata or a Reliance. These are all companies which are now brands, right? Or Birlas. I mean, there's so many of them. We can think of it. And then there are product brands, right? So if you're wearing a Louis Philippe shirt, if you're wearing, if you are consuming Ashirwad Atta, or if you're using Colgate toothpaste, or if you're using Amul butter, right? So again, Amul butter, in terms of being a butter, is a product brand. But then one could argue that Amul butter is far superior as compared to any other product from Amul, right? Which could be, let's say, an Amul milk or Amul paneer. So an Amul paneer is not as big a product brand as an Amul butter, correct? So we can always think of product brands like that. So what would have Amul done? The company became a brand, and now the company is trying to leverage the company brand into product brands. But then not necessarily it is able to leverage in all of those cases. Okay. So we'll try to understand how do you assess brands and how do you value them. Now, one could also argue that what's the difference between a goodwill and a brand and a trademark, right? So goodwill is something which is not separable. Please note this very clearly. The reason why goodwill is not recorded if it is generated internally is because you cannot separate goodwill. Okay. So, for example, again, I'm privileged to be able to take examples of my own company. So, if Omnifin is providing services which are very personalized by Vikash Goyal, right, and the value that Omnifin is generating is only attributable to Vikash Goyal bringing in business, then Omnifin has no brand. Then it is only Vikash Goyal's goodwill, and you may not be able to separate that between Omnifin and Vikash, right? So that is goodwill. That's not the brand. A brand, you should be able to separate it, right? You should be able to leverage it. So goodwill and brand is the biggest, easiest definition or distinction is goodwill cannot be separated from the company. You can't just sell goodwill. You can sell brand. Okay. Then the third part is the trademark. Now, trademark and brand are very well interlinked. Okay. So ideally, if you're valuing an enterprise, can you value enterprise on a DCF basis and then value the brand and add it to the enterprise value? Can you ever do that? Let's look at the responses in the chat window. Can you do an enterprise valuation and do a brand valuation and add the brand value to the enterprise value? Can you do that? Ma'am, can you see if there are responses in the chat window? Very, very important question.
Just now, no questions have been received, but
No,
I'll
no,
check it
I'm
again.
talking about responses. Are they saying yes or no?
Okay, okay. Let me check, sir.
Yes, please.
No responses, sir.
No responses? An enterprise value includes the brand value. You cannot have an enterprise value and then have a brand value and add them to the enterprise value. Brand value is always part of the enterprise value. Okay, you cannot have it separate. If you are having it separately, so and again, we've seen arguments where somebody said that, hey, this company is not recognized, this company is not leveraging the brand as well. I can leverage it. So you can do it only after you've sold it. But as of today, if it is my brand and if it's my company's value will include my brand. Okay, it will not be separated in isolation. So trademark will only help a brand become more recognizable. It will only give a legal right to the brand, right? Nothing else. So you cannot have a very high value of the trademark and then a very high value of the brand which is using the same trademark and then have a and then add this value to the company value. No. Trademark will be subsumed into the brand value in most cases, not a rule, but you have to see whether the brand has a trademark or not. Right? Having a trademark will give some more teeth to the brand, saying that, hey, I will also have some legal right. A very classic example here is, I think it's fairly true, but I read this somewhere that we all know about Tesla cars, right? Now Tesla has been around for a fairly long time, but then it wasn't a global brand for a long time. So now when Tesla entered the Chinese market, right, they could not operate in the Chinese market because in China there was another brand which was Tesla. So the moment Tesla entered the Chinese market, the Chinese Tesla said, hey, you can't operate it. This is an infringement of the Tesla brand that I am operating here. Right? So that's the difference. That's the importance of having a trademark, even if it is not a brand. Okay. Another classic example, I don't know how many of you remember this. I think I'm talking to chartered accountants here. Um, there was a period when there was CFA Institute from the US and there was an ICFI, there's still an ICFI, which used to run the CFA program in India. Now, CFA Institute did not have existence in the Indian market at that time, and ICFI had started the CFA charter much earlier. Now, when CFA Institute wanted to operate in India, it could not operate in India initially, and anybody who had to appear for the CFA exam either had to travel to a US or a Dubai or even Kathmandu for that matter, because CFA Institute was not able to conduct the exams in India because ICFI had the CFA trademark. Eventually, there was a long legal fight, and then CFA Institute had the global rights and it had the North America rights actually, and they finally came up with a global settlement. So ICFI has now stopped offering the CFA charter in India, and CFA Institute has started offering the CFA charter in India. And then the people who had done the ICFI CFA now are only using CFA India to distinguish between CFA and the Indian CFA. So those are examples of trademark rights or trademark fights that can happen because it gives you the legal right. So again, when you look at a brand, you see, do I know about it? Is there a presence of the brand? Does it offer me something? Does it have any relevance? Then okay, it does offer something, but does it also deliver? Right? Is it having any sort of performance? Does it offer something that is better than so again, these three are basic. This is where it starts creating value, right? Does it offer something that is better than the others? And nothing else beats it, right? So is it something that it will really drive customers to this brand only, right? Nothing else beats it. So how much of customer loyalty does it have? How much of price premium does it generate for the company? You have to sort of assess that on a subjective level. These are examples of top global brands in the world. We don't have to talk too much about it. Top brands. So again, how does Interbrand do the brand ranking? It looks at revenue, it looks at presence, it looks at sufficient publicly available data, it looks at economic profit. It says they must have a public profile, so people should be aware of it. And then there's a brand strength score, which should be equal to 50 or above. So these are criteria for assessing the brand by Interbrand. Again, it comes up with these global brand rankings. Similarly, Kantar conducts the brand assessments for the Indian companies, and these are top Indian brands as of 2025. So you have HDFC, TCS, Airtel, Infosys, ICICI, and so on, right? And Kantar values brand like this. So it talks about a financial value, then it talks about a brand contribution, which is the proportion of financial value generated by the brand's ability to increase purchase volume. Multiply this, you get the brand value. Again, this is just for reference. This is not key to what the registered valuers will be doing, so I'm not spending too much time on this. Okay. Now, some of the myths about brands is that some people think that brands have an infinite life. Again, it would usually not have an infinite life. We have to be very careful about taking or considering infinite life of the brand, right? It can be indefinite in some cases, but not infinite. If it is indefinite, then, so for example, we valued brands which are like 125 years old. So would you call them as having infinite lives, right? And they are still generating a lot of value. They're still creating a lot of value. They're still getting premium. So in those cases, we call it as long indefinitely, right? And these are tested for impairment annually. Next, you can add brand value to the enterprise value. We've spoken about it. You cannot. It is always going to be part of the enterprise value. Then we said that brands, goodwill, and trademarks are all the same. We've talked about it, right? And we also sometimes get a lot of queries that we are spending so much money on marketing. So can we add the marketing spends to brand value? So marketing spends can be used to value the brand. There's a method called cost approach. We will talk about it. But marketing value does not equals to the marketing, or marketing spends does not equal to brand value, right? It's not the same thing. Again, I'll take a quick pause and see if there are questions.
There's one question. How do valuer assess the fair market value of goodwill calculated in the balance sheet of acquiry vis-a-vis fair market value available at arm's length sale?
Ma'am, can you repeat that again, please? I want to
Yes,
hear
sir.
that very
How
carefully.
do valuer assess the fair market value of goodwill appeared or calculated in the balance sheet of acquiry as compared to fair market value available at arm's length sale?
So, ma'am, goodwill cannot, in my view, you cannot value goodwill on an arm's length sale basis. Like I said, goodwill is not separable, right?
Yes.
I'm not sure the exact context of this question, but let me try and address it based on what I have understood. So let's say the resolution applicant has acquired another company and that company already has goodwill in its books,
Mhm.
meaning that the corporate debtor would have acquired some other company in the past at a premium and would have recognized goodwill there, right? So when I am when the resolution applicant, now let's say I am acquiring this corporate debtor, there is already goodwill in the corporate debtor's books. So as a valuer, what we will have to see is we will have to see whether this goodwill is still having some value or not. Now again, practical experience says that if a corporate debtor is not doing well, one of the first things to erode is goodwill value. So in my experience, I have never seen an example where a corporate debtor had goodwill in its books, and after the fair value, it continued to have goodwill in its books. That's very, very rare. I'm not saying it cannot happen legally, but uh, again, practical experience says that goodwill will erode first. So if I'm a valuer doing the valuation of this corporate debtor and it has goodwill and I have to see it, I will look at the conditions of these goodwill. When was it acquired? Which company was acquired? How is that company performing even till date? Right? And like I said, very less chance, but that goodwill will get eroded. So that's
Understood.
scenario number one. I
Okay,
think
sir.
that's what the guest is asking. But then
Yeah,
if
I
there's a
think so.
follow-up question, I can take that. I don't know if you can unmute them so that I can hear them directly. Is that
No,
possible?
sir. No, sir.
That
No,
that
sir.
is not possible. So let's see if there's a follow-up question. Okay. I'll move
Okay,
on
sir.
till that time. Thank you so much, ma'am. You're being very helpful.
Yes, sir. Please proceed.
Now, in the past, sorry, there is a follow-up question. No, okay. Yeah. So in the
No, sir.
past, thank you, ma'am. So in the past, there's been some very adventurous things that have happened around brands, right? So we know, I mean, all of us know about this. Whenever there's brand discussion, I've always seen this brand coming up, right? So there was a brand value by a large consultancy firm, and they had put a valuation of 3,000 crores to Kingfisher, right? What Kingfisher did is it leveraged this brand, and then it took some loan based on this brand value, based on the brand value of Kingfisher. Of course, like I said, that brand value and goodwill are some of the first things to erode when a company stops doing well. Okay, so a brand value is in, because like I said, right, if it's a good brand, that means it should be driving good price, good premium, good margins, good profits, etc. So that's not coming. That means you're not able to leverage the brand. The brand value is not doing well. Kingfisher is landing. It's not flying anymore. So therefore, the brand value got eroded, and then the loan had to be restructured and converted into equity. Okay, so you have to be very careful about being too adventurous with respect to brand value. Now, how do you start assessing the brand? So you will see what is the impact of this brand on the customers, on the employees, and on the investors. Again, so until and unless these criteria fulfill, it's very hard to defend a good brand value. So you should be able to attract, retain, and motivate good talent. You should be able to influence customer choice and create loyalty and encourage purchase behavior in your favor. And you should be able to lower the cost of financing. So you should be able to attract investors. You should be able to get a loan at a very low cost. And of course, you should be able to drive performance, right? So price, premium, and margins. So all of that, if it is happening, then only we can say that it's a reasonably good brand. So one of the most common ways of valuing brand, I'll go to that model first and come back to this, is the relief from royalty method, right? So what does this relief from royalty method say? Relief from royalty method says that what if your brand belonged to somebody else and you were paying a royalty to use it, right? So for example, if okay, so let's take a simplified example and then come to royalty again. Um, mm, 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 mm. So let's say there's this very large valuation firm, right, which is always able to get business before Omnifin gets it, right? So if whenever we are going and talking to a client, the client says, hey, we've given this business to this other firm, right? Now I am not happy with this whole situation because I'm working very hard to get business, and then this firm always ends up getting the business. We are having good quality and all of that, but still, this is an example. So now what if I want to drive the same value? So I go to this firm and say, sir, you are always ahead of me. So why don't I start using your name? And you can see my quality. My quality is good. My team is good. We have good presence, etc., etc., etc. But I am not able to drive as much business as you are. So can I use your name? What will this company do? The company will, hopefully, again hypothetically, the company will say, okay, I want X amount of money as upfront payment, and then Y percentage of revenue that you will get, and I will still command that you have to use this logo, this is the approach, these kind of templates, these kind of presentations, these kind of quality mechanisms, etc., etc., etc. Right? So how would be the value of this brand if this company was not having its own brand, but was having to pay a royalty to use that same name, right? So how much royalty is this company saving by having its own brand is what the relief from royalty method says. Okay. Now, the biggest challenge, it's a very easy method, to be honest, right? The biggest challenge in relief from royalty method is to get the royalty rates. Now, globally speaking, there are some databases which are available, and these are very pricey databases, to be honest. But these databases will allow you to get the royalty rates. Unfortunately, we don't come across too many such databases in India which captures the royalty rates, right? So basically, how would you get this? So you need to have a lot of access to agreements, right? The licensing agreements or franchise agreements, where they have talked about a percentage of royalty, right? So how do you look at the valuation under the relief from royalty method? You forecast the financial data of the company, like the revenues, the taxes, and the growth. You calculate the notional royalty rates by analyzing what similar companies are charging for similar assets. You calculate the royalty savings by applying a royalty rate. Estimate the after-tax royalty savings by charging taxes. So basically, put a tax to it. You discount the cash flows. Use the tax amortization benefit factor if applicable. I'll talk about what is a tab factor. And then assess the terminal value if it is a long-lived intangible or long-lived brand. Okay. So very quickly, let's take an example and we'll explain some of these terms there. So example, these are some of the agreements that we've evaluated. Right? I have the example in the next slide, where in all of these agreements, right, this is the average royalty rate. So we have selected the average royalty rate at, let's say, 5%. It's an apparel company brand that we are evaluating, not an Indian example, just to be clear. Okay. So you see so many agreements, you look at the average royalty rates and you select the royalty rate of 5%. Now, how do you value the brand using relief from royalty method? So you have the revenue of the company, right? Of the company. These are the projected revenues. How would you get this? You would get this projected revenue from the management. Now we said that royalty is 5%. So what is the royalty savings that this company is having? If this company did not have its own brand, it would have to pay this much royalty to the brand owner by having a licensing agreement, right? Why would the company do that? Because this revenue is a function of a very high price or a very high premium, high volume that this brand is able to generate. So royalty savings is this. You put it after tax because you would have saved some taxes also if you had paid some royalty. So 25% is that. So you have the after tax royalty savings. You discount at the rate of 20%. So again, we will calculate 20%. So again, see, 20% is usually going to be slightly more than the cost of equity. Okay. So the minimum benchmark that you would think of for discount rates in case of intangibles like brands is the minimum would be the cost of equity. And usually your discount rate would be slightly more than that. Why? Because these are very fragile assets. These are very, very fragile assets. So typically what practitioners like us do is we look at the cost of equity and then we add a slight premium to it, depending on, again, how ambitious the forecasts are, how sensitive the market is to the advertisement spends and so on and so forth. Based on this, we take a discount rate. So you have the discount factor, right? And then we have assumed that there is going to be a terminal period. Like I said, right? In many cases, you will not have this. So we took this because it was a 45-year-old brand already. Okay, in this example, this was a 45-year-old brand, and it was still able to drive reasonable premium. You see the revenue forecasts are reasonably high. So you have that, you have the discounted savings, and then you look at a tax amortization benefit. Now, what is this? What is tax amortization benefit? If I am able to recognize this intangible in my books, does my regulation, does my jurisdiction, in India, in our example, allows me to amortize this brand for tax purposes? If yes, then by having this brand, by owning this brand, by recognizing this brand, I will be able to amortize it over a certain period. It could be 4 years, 5 years, 8 years, 15 years, whatever. So that tax benefit will be added to the sum of the discounted savings, and you get the estimated fair value of the trade name stroke brand name in this example, right? So this is how we would look at the relief from royalty method brand valuation, a simple example. And then there can be complex examples. We'll take a couple of more methods as well. Any questions so far?
No, sir.
Okay. So then there can be, I'll come to the multi-period excess earnings at the end. Then there can be with and without method. So again, the easiest way of assessing a brand value, although we don't use this method very commonly, just out of the global practices, is the with and the without method. So basically, if I was an ordinary practitioner, if I was an ordinary company, I could be a tea company, I could be a shaving cream company, I could be a detergent company, etc. And I had no brand, right? If I was an ordinary player in the market, what would be my DCF value? And second scenario, with the brand being there, what is my DCF value, right? The difference of the two is going to give me the value of the brand. It's as simple as that. I don't have an example to show you this here. And typically we use this for intangibles like non-compete agreements. Why we don't use it for brands is because of the estimation problems, right? So if I am valuing a brand, I know this is what my forecast is. But if my without scenario is a very important problem. I mean, it's the biggest problem, because how do I know what would be my revenue without the brand? So the assumptions are usually very large. So therefore, we don't apply this very commonly in case of brands. We do apply this in case of non-compete agreements, right? But like I said, intuitively, this is the easiest way to value the intangibles. Next, we talk about the cost approach, right? We said that marketing spends can be used for valuing the brands, right? Now, this is not a fair value approach, but this does appear in the books. How do you value a brand based on the marketing spends? Because marketing spends contribute to the brand value. So sometimes we use it to only assess the baseline value of the brand. It does not give us any future economic benefits or anything, but it will just give us a baseline value. What does this method do? This method basically capitalizes the past marketing expenses and amortizes it gradually. So the aggregate of the unamortized amount is the brand value. Again, we call it the conservative approach to brand valuation. Again, let's understand what we are doing here, why we are doing here. So think of the Nirma advertisement. Everyone remembers the Nirma advertisement, right? But when was the last time you saw that advertisement on TV? I haven't seen it in years, probably decades, right? But that ad still stays in our mind, yes or no? That Onita advertisement with that guy with a horn, couple of horns, right? Think of Pena Hi Lena, right? Think of Amul advertisements. Amul, we still see that around. But some of those legacy Vico turmeric, Nai cosmetic, Vico turmeric Ayurvedic cream. I mean, you only see that in movie halls probably, right? But nowhere else. So These are brands which have become legacy brands. I mean, they've been around for a very, very long time. So, but then, do you recall the new advertisements or the advertisements of new companies these days? The answer is no, right? So these brands had become legacy brands when the brands were not there in abundance. Today, in Instagram, in times of Instagram, we are seeing brands with every 3 scrolls, right? It's all over the place. So now, how do you decide whether the brand will reap a 4-year period? Now, again, that's where the biggest judgment comes into play. Okay. So the cost approach says that you have to estimate what is the life of the advertisement expense. Again, how do you know what is the life of the advertisement expense? So you will have to do a lot of these surveys. So for example, at Omnifin, we do a detailed brand survey, right? And we have a 100-point scoring matrix based on which we are able to justify some of these things, right? So what we are saying here is that what is the advertisement expense, and for how many years the customer will recall this advertisement, right? Or the company will be able to benefit from this advertisement expense. Based on this, we will amortize this. So again, for financial reporting purposes, I cannot capitalize the branding expense or the marketing expense, but only for valuation purposes, if I have to conservatively look at the value of a brand, I could probably do this. So what are we doing here? We are assuming that the advertisement expenses are expected to reap benefits for a 4-year period, and the brand can be assessed. So accordingly, how would you assess the brand? So this is my advertisement spend in the year 2021, 22, 23, 24, and 25. These are my brand spends. I'm in the year 2025, assuming that my spends are at the end of the year. So 100% of this is unamortized. Okay. Whatever I have spent. So again, this is a simplified example. Usually you would spread it over a year, over a period, and so on. So in my assumption, FY25, 100% of it is unamortized, end of the year spends. FY24, 75% is unamortized, right? 25% is amortized. So this was my spend 912 80,000. Out of this, 25% has been amortized, meaning it was consumed in 2024, so the benefit will not be passed on anymore. 75% of it is still reaping benefits for us. FY23, 2 years have passed, so half of it is unamortized. 22, 3 years have passed, only 25% is amortized, and 4th year, nothing is unamortized. So you add all these and you get the value of the brand, which is the unamortized expense. Okay, this becomes your value of the brand under the cost approach in our example. Again, I will take a pause. If there are questions, we'll be happy to take it.
No, sir.
Yeah, ma'am, I'll still pause for 5-7 minutes and see if there are still questions.
Yes, sir. Yes, sir. Yes, sir.
Yeah. Let's give them time if they want to ask. And that's the reason why I didn't want to keep the questions till the end,
Yes, sir.
because if we're discussing a lot of concepts and numbers, so yeah, we will still have time at the end, but if there are questions now, we can start.
Yes, yes, sir.
Okay. All right. So I will move to the multi-period excess earning method. It's a reasonably complex method, very commonly used in case of purchase price allocation for valuing complex intangibles, right? So what does the excess earning do? Again, let's understand this very simply, that any intangible, right, if it is recorded as an asset, we've talked about the identifiability criteria, and most important is the future economic benefit criteria, right? So if an intangible is helping me generate future economic benefits, and we've talked about the requirements under Ind AS 38, that you need to be able to have reasonable assumptions around how that benefit will accrue to you. So what does the excess earning method say? The excess earning method is simply saying that this intangible is helping you earn an excess profit, right, or excess earnings, and this is also known as multi-period excess earning method, MPEEM, or commonly pronounced as MEEM, MEEM. That's how it's pronounced, right? So here what we have to do is we have to estimate the value of the enterprise. Again, this is an independent example. We are taking an example of a technology. So there is, let's say, a forecasted revenue of the entity, and now the company is saying that this is the revenue that is attributable to the technology. Now this is the most crucial part, and it's not covered in this example. So usually the management will give you that estimate. Again, this estimate can come from various ways. It could come from with and without method. It could come from capacity utilization. It could come from market assessment. There's n number of ways of being able to do that, right? So what is the revenue that is attributable to the technology? Now, so this is revenue. So you have an EBIT margin. So you take that EBIT margin. In our example, it is 10%. So you have earnings before interest and tax, less taxes, again 25%. So you have earnings after tax. Now here, there's a very important concept called contributory asset charge. Okay, and this is very, very crucial and a very important concept. What is this? So let's try to recall our discounted cash flow calculation. What do we do in case of discounted cash flow when we are calculating the free cash flow? For a business, this is probably where we start with, right? Profit after tax. And then we make adjustments towards depreciation. So we bring it cash profit after tax. After the cash profit, we deduct at least two things. We deduct the investment in non-cash working capital, and we deduct capex. What is it? What are we talking about here? We are saying that for the business, I mean, I have earned this much amount of profits, and this is the after-tax cash profit, but I can't take this profit home, right? I would need to, if my business has to grow, I would need to reinvest some of my profit into working capital and some of my profits into capex, because my working capital will help me meet my short-term funding needs, and my capex will help me meet my long-term funding needs, right? So, for example, I have an inventory of 1,000 right now. If my profit has to grow, I would need more investments into inventory. So if I have an inventory of 1,000 this year and an inventory of 1,200 next year, the 200 would have to be invested from my profits. That's my investment in non-cash working capital. Similarly, I would have to invest into capex as well, right? So I deduct those to get the free cash flow. We have a similar adjustment here. Yes, ma'am.
So there are two questions. One, I think the topic that you were discussing, it's related to that. What if we initially think it will last 4 years, but after 2 years, we feel it will last a little longer?
So, ma'am, I think again, this is more of an accounting question, because valuation will have to be done at a point in time.
Yes,
okay.
sir.
Ind AS does talk about the concept of impairment. So you can do the impairment. Ind AS also allows you to opt for the cost model or the revaluation model, right? If you are using the revaluation model, it will allow you to revalue it every year, and then again you will have to go back to the Ind AS standards and see whether an intangible can be upward valued or not, right? So the easiest way would be that if you've recorded an intangible thinking that the life is 2 years, but after 2 years you think that it's going to last 2 years more, right? Basically your asset is not impaired. So you will leave the cost as it is, and you don't have to do the impairment. If it is amortization, you have to do the amortization. That's more of an accounting question.
Yes, sir. Yes, sir. Okay, sir. So there's another question. What shall be other criteria for adopting the cost approach? It is also related to that, sir.
So again, there's no guidance around it, right? If we do not have any forecasted information about the brand, and we still think, so again, I think in case of CIRP engagements, right, my sense is, and this is my personal sense, is that most of the brands will be valued based on the cost approach only. Again, the reason is that if I'm a valuer which is valuing a corporate debtor, it is very unlikely that the resolution professional will be able to give me a forecasted information. They will not have the forecasted information. Resolution applicant is not there in the picture, so I will not get that. And the corporate debtor himself, the management of the company, is again not having any information because they are not having any control of the organization. So if I have to value a brand, how would I value it? because I don't have the forecasted information. So the easiest way for me to assign any value to brand is going to be the cost approach only.
Got it.
That's the safest approach, right? So
Yes,
in my
yes.
sense, again, this is my personal view, and we have a long way to go before this gets operationalized. But a lot of these valuations will happen at cost approach only in case of CIR, because we will have the historical data.
Sir, please proceed.
Thank you so much. So again, in case of multi-period excess earning model, right, we have something called contributory asset charges, where we have to assign a contributory asset charge towards working capital, a contributory asset charge towards fixed assets, and a contributory asset charge towards assembled workforce. Right now, this is a multi-step process. So let's understand where we are coming from. So here, what we have done is we have earnings after tax of 491, and we have a revenue of 58656. So this 1% is charged on 58656. Okay. Now, so again, for every year that I have a revenue, right? Sorry, there's something wrong here. What is this? I'll have to see whether these numbers are tying back or not. Please excuse me for this. But so I have to take this 1%. Similarly, I will have this fixed asset charge of 1.6% and contributory asset charge towards AWF, that is assembled workforce, of 0.8%. Again, don't worry about the numbers for the time being. I think there is a casting error here. But let's try to talk about how do we get this 1% or 1.6% or 0.8%. Okay, like I said, this is going to be a multi-step approach. So my enterprise revenue in this case was 136,080. My average fixed asset is 40590. These are coming from my projections. Okay. Now, what is my return required on fixed asset? Here, I have 9.1%. Similarly, required return on net working capital is 8.6%. And required return on AWF is 10.9%. So I started with 1%. Now I moved to 9.1%. Where am I getting this 9.1% from? Here. So in my business, I have to split the required rate of return, which I normally calculate for the entire business. Now I have to split it between fixed assets and net working capital and assembled workforce and technology, because I'm valuing technology as well. Okay. So in case of fixed asset, what is my cost of equity? I get the cost of equity like I normally calculate for any business. So my risk-free rate is 7.3, market return is 13.4, equity risk premium is 6.1, beta is 0.82. I've got it from the peer companies. And because this is a distressed company in my example, I have a size premium of 1%, distress premium of 2.5. So I get the cost of equity at 15.8%. Similarly, I have the post-tax cost of debt. So there were some bonds. I have the government bond rate. I added the two, right? So I got 8.55. I have an additional risk premium. So I got 0.45. This becomes my pre-tax cost of debt, right? I adjust it for tax rates and I get the post-tax cost of debt of 6.7%. So these are fairly okay, right? I also have the proportion of debt and equity based on market participants. Why am I doing it based on market participants? Because it's a distressed company, right? The debt equity would be highly skewed in any case. So therefore, I have the market participants based weights of debt and equity. Based on this, I get the WACC of 12.63%. We'll park this for the time being. Now, this is where the biggest judgment comes in. Let me take a pause. Are we all okay till this point? Are we understanding this example? And I'll then come to this part. Are we good so far? 2 hours, we have a lot of things to cover. So I just want to ensure that we are all on the same page.
Yes, sir.
I'll take a 5-second pause, ma'am, and let's see if people have any questions.
Yes, sir. Yes.
So once again, what we've done so far is we have got the company projections. We have got the revenue, which is attributable to the technology. I have taken an EBIT percentage margin, profit margin, basically. I've deducted the taxes. I got the earnings after tax. That part is usually okay. Now my calculation will require me, I am required to calculate the contributory asset charge. How do I get the contributory asset charge? I have got the enterprise revenue and I've got the average fixed assets. So now my task is to calculate what is the required return on the fixed assets. So if as a business, how much return should I earn on the fixed assets, right? If my return is earned at 9.1%, I know that it's going to be 136,080 into 9.1%, right? But what is the required return on fixed assets? I have to calculate this. How do I calculate this? I have to split my cost of debt and cost of equity into the fixed assets, net working capital, assembled workforce, and technology. Basically, 4 criteria. So I've got the cost of equity, cost of debt, and cost of capital. I've got that. Now, this is where the valuer assumption comes into play. Again, everything else is easily explainable. The valuer assumption would mean that normally, what is the funding proportion of fixed assets into the business? So if my company has some sort of debt, right, normally I would see that 85% of the fixed asset is financed in the form of debt, 15% is financed in the form of equity. How am I getting this information? I am getting this information based on industry practices. In this industry, this is what I saw. A more logical way of explaining this, if I had to take a loan, right, on what will I get loan very easily? On fixed assets or working capital or assembled workforce or technology? So it's very easy to get CC loans or short-term loans on working capital. You get those loans very easily. So it will be in the range of, let's say, 10 and 15% of equity, and balance is debt. Similarly, for most of the companies, you will see this project financing done, right, where the long-term assets are mortgaged and the company gets a loan on this. So 85% of my fixed asset is financed by debt, 15% is financed by equity. So this is based on an assumption. This is based on market observation. So one could say I could take 90% in both the cases. Yes, I could. Okay. One could say 80% in both the cases. I still could. It would still be defensible. All right. Then I have assembled workforce. Now this, I don't remember the workings for this, but this also came from some calculations. And technology is 100% equity finance, because if I went to a bank and said, hey, I have this technology which is not patented, it is just there, it is helping me drive better margins, I want to mortgage it, I would not get any loan on this technology. So this is going to be 100% equity finance. Ma'am, there was some question. You're on mute, ma'am. Sorry.
So there's one question. Who shall be responsible for providing projections to the valuer? And what shall be basis for the same under such circumstances?
I think I already answered that in my previous example, ma'am. So under CIRP, usually it is not likely that the resolution professional will get it. But I think when this rule starts getting operationalized, right, that accountability will also fall on somebody. Okay. Now, I'm celebrating one of the arguments that I've been pushing in the last 5-6 years, that intangible should be valued. My view is also that, what if I was a research analyst giving stock price opinions? I would drive my own projections, right? So why can't I do this in case of intangibles? I know this is controversial. The resolution professional should be able to give it. The management could be able to give it. The incoming resolution applicant could give it. Valuer could do it on their own, or valuer could do it purely based on the historical numbers only, and not take any financial projections. For example, there is a method called DCF and there is a method called PECV, right? Capitalization of earnings method. So we use capitalization of earnings method when the projections are not available, if we have to apply the income approach. So the same thing can also be done there, right? So it's a very, very valid question. And I don't have a clear answer right now because I don't have that crystal ball. But I think it's a very good direction, that it's a bigger responsibility to identify that intangible rather than discussing that who will take the accountability of the projection, in my view. Right?
Yes, sir.
Okay.
Proceed.
So based on this, what I have is, I've got the proportion of debt and equity. I've got the cost of equity, post-tax cost of debt. So I get the required rate of return on each asset. You see, I've got this. So fixed assets, I've got 15.8 into 15% plus 6.7 into 85%, 8.1%. Net working capital 15.8 into 10% plus 6.7 into 90%. I've got 7.64% and so on. Now I could stop here, or I could still attach a premium and get an adjusted return. So I could stop here or I could stop here. It's up to me. It's again based on the valuer's observation, but this helps me get the required rate of return. Now you see this 9.1%, 8.64%, 10.92% are what is used here, right? 9.1, 8.6, 10. So what is the required return on fixed assets? So my fixed asset is 40950. On this 9% gives me 3692. This is the required return on the fixed asset. 40585 again, that's the required return on fixed assets and so on. So I've got the required return. Required return on fixed asset divided by revenue gives me 2.7%. So this divided by revenue, 2.7%. I got it for every year. This is my average of this entire period. Okay, so 1.6%. Similarly, I would do it for net working capital. Similarly, I would do it for assembled workforce. Assembled workforce can be slightly tricky. We'll skip it for our today's session. But again, the calculations would normally hover around the cost of hiring the resources, the cost of training the resources, the cost of retaining the resources, what's your total cost, and so on. Okay, so in this example, what we had taken was 60% of other manufacturing and other expenses was considered as the workforce cost, the expenses, right? So I get this. So I've multiplied these revenue, these profit figures with the contributory asset charge. I get the excess earnings. I use a discount factor at the rate of, we took at 18.31%. So this is at the rate of 18.31%. And again, you see, in this case, we did not take a terminal value because in our assessment, the technology would not drive excess earnings beyond 8 years. So we felt that the useful life of this technology will not exceed 8 years. Some could argue only 2 years again. So again, for the question that we had, that who will provide projections, you could take only 1 year or 2 years. Okay. And then we had the tax amortization benefit factor, which is 0.1244. So this into 1 plus 1.1244 would give us the value of technology, right? Just to complete the entire example, how do you get the TAP factor? So in our example, we believe that the tax benefit will be available for 8 years. So my period is 1 by 8, 2 by 8, and so on. So I've got the period factor. Percentage year, so again, percentage divided by the year. So 1.125 divided by 1, 13%, and so on. The tax rate is 25.17. So discounted for the asset is 18.31. So what is my PV factor for the tax rate in each of the year? And I take the sum of this to get the TAP factor. Okay, so 459.4 into 1.1244 would give us the value of technology. Okay, I'll take another pause and see if you have any questions.
No, sir.
Moving on, so what are some of the factors that we have to keep in mind? Intangible assets will have higher risk than tangible assets, please remember, and that's why your discount rates will be more than the cost of equity usually. If an intangible is highly specialized to its current use, it may have higher risk than assets with multiple potential uses. Okay, so a very important subjective assessment needs to be done. If an intangible is very specialized to its current use, single intangible assets may have more risk than group of assets, again, because they are more prone to obsolescence. Life of the asset is again very important. We've constantly talked about it. And intangible assets with more readily estimable cash flows are usually valued higher than the ones which do not have a readily estimable cash flows. So I think that's about it from my side. What I can also do is just to give you a very quick sense. I think there was one slide which was hidden. I'll go there and talk about what are those factors. So if you see what are the subjective ways of assessing the kind of premiums that we assign, so you would look at customers. So a very strong assessment of the customers in case of brand. So we assess whether the customers score on the brand based on at least three factors: price premium, volume premium, and customer satisfaction. So there are surveys which are conducted. You look at the employee, so impact of the brand on the employee. So we assess how the employees are attracted to the brand and how much do they stick to the brand. Are they able to attract and retain talent? Third, how does brand attract investors? The cheaper the funds the brand can command, more valuable it is. So reduce cost of funds and easier access to them. Then presence. So what is the presence of this brand, right? Is it popular to its known stakeholders? Is it a mass brand or a niche brand? How is it positioned? They are the key factors affecting its value. Differentiation and extension of the presence, but not popularity on its position. So how is the brand differentiated against its competitors? Does it have a visible USP that the stakeholders can identify? And the governance piece, which is also catching up a lot, right? So what does the brand score on the governance, ethics, and best practices, and positive contribution to the society? So these are some of the areas that we score the brand on, based on which we are able to defend the kind of assumptions that we are taking, whether it's going to have a long life, terminal period should be taken or not, right? How much premium should we add over and above the risk, the equity premium, the equity risk premium, or the cost of equity, are some of the things that are discussed or assessed based on these assessments, the subjective assessments. So I think I'm good for now, and we can take any questions that participants have. I think we have you spoke about 20 minutes for the Q&A.
Yes, sir. So just a minute.
Yes.
Right now, there are no more questions.
Okay. So you can guide me on the next steps, ma'am. I'm okay. I think I've covered.
So,
I don't know if it was too fast.
shall we ask them to give their questions 5 minutes time?
Yeah, sure. Absolutely. Honestly, I wasn't. I missed the fact that we will not have interaction amongst the
Okay.
participants. That was
Okay,
always
sir.
that's usually always built into the program that I do. So yeah, it was my bad. I should have thought more about it earlier.
But actually, webinars are conducted this way
No,
only.
yeah. I'm yeah. Like I said, my bad. Yes,
Yes.
completely my bad.
I think they have asked all their questions.
Okay, perfect. Sounds good. So
So,
you can let me go then, or you'll have to wait for the
Yes, sir.
answer to come. I mean,
Sir,
whatever way.
actually, well-explained topic. Don't need much questions. You have already taken up all questions.
All right. Okay. Great.
So
So,
thank you so much, sir,
thank
for
you so much,
this
ma'am.
wonderful session on this topic.
Thank you
Thank you
so much
very
for
much for
having me
giving
here.
your time.
Thank
Thank
you.
you,
Thank
sir.
you very much.
Thank you. Yes, yes. Please stop the recording.